From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. Today we're breaking down the Federal Reserve's September 2025 decision to lower interest rates. To explore what this means for you regarding your jobs, inflation, tariffs, recession risks, and more, I'm joined by Jerry Herman, one of our 5 chartered financial analysts on our investment committee. So let's start with the Fed's basics of the Fed's mission. The Federal Reserve operates under what's called the dual mandate. So can you explain what this dual mandate is?
So the dual mandate is the goals of the Fed are to maximize employment and control inflation. And they do that through their policies to support job growth and control prices.
So it looks like several factors came together recently. Job growth has slowed compared to the robust pace we saw a few years ago. And inflation, while much lower than the peak of 2022, has fully settled to the Fed's 2% target.
That's right. And the Fed made the judgment that there was greater risk to employment and growth versus inflation, so it eased rates to support the economy.
Yeah, so let's focus on jobs. How do the lower interest rates help the labor market?
So lower rates reduce the cost of borrowing, which makes it cheaper for businesses to invest, to expand, to retain employees. And employees or consumers can benefit from lower rates on mortgages and autos and credit cards. That sustains spending, which supports jobs.
And what about inflation? Some people worry cheaper credit combined with tariffs will, reignite inflation.
So that's a balancing act. Tariffs have put upward pressure on pricing, even though inflation has trended down. The Fed believes that the economy can absorb those higher tariff-related costs, and it also had made the judgment that it's worth supporting growth and that inflation won't reignite.
And many people are concerned that a rate cut means a recession's coming. So does the cut signal that a recession's looming around the corner?
So rates cuts happen in both recessionary and non-recessionary environments. Rate cuts can extend an expansion or avoid a recession. For example, in 1995 and 2019, there was no recession and the financial markets actually did really well. If a recession follows, like in 01 or 07 or 08, the markets initially rallied, then took a sharp downturn as demand contracted.
So how have the financial markets done both under these scenarios?
So Northern Trust did a study dating back to 1980, the 11 rate cut cycles, and they found that the average return 12-month hence was about 14%. When there was no recession, it was actually stronger, 21%. And during recessionary times, the results were weaker and much more volatile.
So it really depends on this economy is going to hold up or not.
Yeah, that's right. The September cuts, if they're able to extend the economy, then the next year should be pretty good. If we're actually slipping into recession already, history tells us that the market may fade, the rally may fade.
And if we only had the crystal ball, that'd be great. So if you want to know if your portfolio is prepared either way, give us a call. Here's Fox News Sunday.